On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. Morning team, hope you're all well. Let's run through what was a truly memorable period for investors last week, then we'll turn our attention to what is coming up in the days ahead. So last week, geez, what a week it was. The S&P 500 index in the US experienced 5 consecutive days of intraday ranges more than 6%. Some of that was the week before and then it flowed into last week as well. And in close to 100 years, the only times we've seen that were at the peak of the GFC in 2008 and then again in the early days of the pandemic in 2020. So not something you see very often at all. The S&P 500 did end the week up 5.7%, so a nice rebound. That saw it finish 12.7% down from its February highs, and it was down 18.9% at its weakest point. I think that was on Tuesday or Wednesday at the close. Very close to bear market territory there, which is of course a 20% decline. Most other markets finished last week slightly lower. Other markets around the world haven't been quite as volatile as the US, but most of them were down for the week. The local NZX 50 1.7% lower. Now, despite last week's partial tariff backtrack from the White House, the US 10-year bond yield ended the week up at 4.5%, and that compares with just under 4% 7 days earlier. This is a huge story, to be honest. That was the biggest weekly jump, 0.5%, the biggest weekly jump since 2001, and it comes as investors are really exiting US assets en masse in favour of other parts of the world. So we saw that in the US dollar as well. The US dollar index fell to its lowest level since July 2023, so almost 2 years ago, and the greenback is down 9% from where it was in the middle of January. So investors are not completely giving up on US assets, but they don't want to have nearly as many of them as they had before. So they're dumping shares, dumping treasuries, moving the money out of the US to other parts of the world, and that is impacting on the US dollar. So what you're seeing there in terms of currency markets and bond markets is just as important as what you're seeing in terms of the NASDAQ, the S&P 500, and all of those equity indices. Right, let's run through some of the key developments last week. And it wasn't all about the US because we did have some big news here in New Zealand. We had an OCR decision where the Reserve Bank of New Zealand reduced the official cash rate again by another 0.25%. That was fully expected. It was the 5th reduction since August last year, and that takes us to 200 points of cumulative cuts that have seen the OCR fall from a 16-year high of 5.5% to 3.5% today. Now, the Reserve Bank didn't say too much about what's going on out there. They did note that the US tariff announcements will have a negative impact on global growth and that will flow through to us here in New Zealand. They also did talk about how that trade diversion could lower the prices for some of our imports, so that could actually see inflation a little bit lower over the medium term. They're monitoring the situation like we are, but right now, reading that statement, it feels to me like the path for the OCR could be a little lower than previously expected. So from here, I think we get another 0.25% cut at the next meeting, which is in late May, and then I think the OCR will keep going down maybe not every meeting. There may be a few pauses in there, but I think it probably ends up in the high twos, so a little lower than we thought before. You didn't see a huge reaction from mortgage rates apart from the floating rates after last week, and I think that's because it was fully expected. So most of those mortgage rates have moved in advance, so that's why you haven't seen an immediate decline in, the 1 year, 2 year, 3 year rate. So that was the OCR. We also had some US inflation figures, which were much better than expected, actually. And under normal circumstances, these would have been cheered by the market and they probably would have fueled a pretty solid rally across risk assets. But at the moment, everyone's so focused on tariffs that it just went unnoticed. The headline and the core CPI, the Consumer Price Index, were both lower than expected. On a monthly basis, and both of those were the weakest that we've seen in several months. So that's good news. The headline CPI increased at an annual pace of 2.4%. That's the lowest in 6 months, and it's below what people were expecting. People were expecting 2.6, came in at 2.4. And the core CPI rose 2.8%. That was below forecast for 3%, and it was actually the weakest that we've seen since March 2021, 4 years ago. So I know the game has changed because now we've got tariffs in the mix that could put some upward pressure on US prices and US inflation, but up till now, and these figures that sort of go through to the end of March, things were looking pretty good in terms of that US inflation picture. Right, looking ahead, there is plenty going on. Let's start here in New Zealand. We will have a dairy auction. This will be out on Wednesday morning, so we'll be watching to see if the ructions of the past week or two have had any impact on prices or demand. Go back to a fortnight ago, prices were a bit mixed. You saw some big swings in between products. However, the headline GDT index still rose 1.1%. That was the best result in 2 months. Prices are up almost 4% so far this year, and a Fonterra payout of at least $10 appears to be locked in. So that is good news, but we just need to monitor the situation because commodities can be very volatile, and China's a big buyer of dairy products, obviously, and they are right in the firing line in terms of these US tariffs. We'll also have New Zealand inflation figures for the March 2025 quarter. These will probably be the highlight for the week. 10:45 on Wednesday. The Reserve Bank expecting the CPI to have increased 0.8% in the March 2025 quarter. That'll be the highest in 18 months, but on a quarter-to-quarter basis, it can bounce around a little bit. The annual inflation rate expected to rise slightly to 2.4%. Those are the Reserve Bank's figures. I think the economists out there are expecting it to come up, but only more slightly, to 2.3. It was 2.2% last time, so a little bit of a rise there, but still well within that target band of 1 to 3%. So I don't think this will really move markets in a big way. A day earlier than that, we will get the selected price indices, which will be a little bit more up to date, and we'll cover where prices for some products have gone in the more recent history. So that'll be something we're watching too. Actually, that CPI might be Thursday, that New Zealand inflation report. So either Wednesday or Thursday, 10:45 a.m. I better check those dates and make sure I get that right. A housing market report too. We should get this week from the Real Estate Institute. This could be out on Monday, Tuesday, I'm not sure, to be honest. They don't give us a firm date, but expecting it sometime this week. This will cover the month of March, so we'll be watching for any signs of an improving market. Mortgage rates have come down from where they were 6 months ago, a year ago. The economy is more stable, but obviously now you've got all of these global issues, which understandably will be causing people to just be a little bit cautious potentially. So there's probably a bit of a push-pull out there. The February figures weren't fantastic, but they did show us that things were starting to improve. So there were signs of life, and we saw prices starting to push a little bit higher, so that will be important. So those are the key things on the local front. It will be a holiday-shortened week as well. We've obviously got the Easter holidays, so Good Friday. Markets here in New Zealand will be closed. Same in the US. The US will be closed. Equity markets, bond markets, and the bond markets in the US actually close early on Thursday too. So it'll be a shorter week than usual in terms of most financial markets. Out there in the world, we've got a few monetary policy decisions to monitor. The ECB and the Bank of Canada have monetary policy decisions coming up. The ECB will be interesting. I think they meet on Thursday, widely tipped to cut their policy rate by 0.25%. That would see it down at 2.25%. They got to a high of 4% last year. So inflation been coming down in Europe. It's sitting at 2.2%. So that's good news. And I think you'll see further cuts from the ECB that will see that policy rate end up below 2% over the second half of this year. And the Bank of Canada too, will be watching that one. Also a couple of speeches from Fed officials, the most interesting of which will be Fed Chair Jerome Powell, who is scheduled to speak on Wednesday at the Economic Club of Chicago. So keep an eye on that one. On the economic front, there's quite a bit going on. We've got March quarter GDP readings from the US and from China. We've got fresh inflation figures, not just here in New Zealand, but also in the UK and in Japan. So all of those things will be of interest. It does feel like some of these economic releases are kind of outdated now. Because obviously the game has changed in terms of the tariffs that we've seen announced in April and all the volatility there. So some of these releases that we're getting that cover the March quarter or the month of March, it kind of feels like they don't mean as much as they usually would. So we'll be watching all those things, but they probably don't hold the same level of importance. There's a meeting on Thursday at the White House between President Trump and the Italian Prime Minister, so that will be in focus. You've obviously got tariffs between the US and the European Union on the table at the moment, so that is likely to be a key topic of discussion on Thursday, so we'll be watching for any news flow on that. It's also the global reporting season. We saw some of the big US banks kick that off on Friday night, so that will continue. I think there's 35 S&P 500 companies scheduled to release results this week, about 5 Dow components, so plenty to watch, and then the reporting season will ramp up in the weeks ahead. So right now, this will be for the March quarter, by the way, right now the analysts are expecting S&P 500 aggregate earnings year on year to have grown 7.3% for the first quarter. So that will be solid. And for the whole of 2025, they're expecting earnings growth of just above 10%. So that's an interesting one. Analysts aren't always the quickest to adjust earnings when you get big changes in the macro outlook. They can be a little bit slow to respond, and the macro outlook has definitely changed. So I'm not sure if that earnings growth estimate of 10.6% will still be in place in a month or two's time, but we will be watching all of these releases this week and over the coming weeks from corporates to see if companies will stick with their guidance or whether they'll withdraw that guidance, because most of them give guidance for the whole year to just give people a bit of clarity. But what you see during times of uncertainty, and we saw this back with the COVID lockdowns, is they just withdraw that guidance. They say, look, we don't know, it's too hard, don't know what the policy settings look like, don't know what's going to happen, so that guidance is no longer appropriate, and we're not going to give you any new guidance until we know more. And that always creates an additional level of uncertainty, because if the management team and the board don't know what they're going to earn, then how are we as investors or analysts supposed to figure that out? They're inside the tent and they don't know. We're on the outside with a lot less information about their individual businesses. So that's something to watch. It could make this reporting season solid in the sense that the numbers will look good for the March quarter. I suspect they will in most cases, but those outlook commentaries could be very guarded, which would see investors remain cautious, as they have been for the last few weeks, obviously. So some of the companies we'll be watching this week: Goldman Sachs, Bank of America, Johnson & Johnson, ASML, Netflix, United Health, TSMC. Lots of highlights there. Not too much happening on the local front when it comes to corporate releases or across the Tasman, but over this week and next week and the one after that, there will be plenty to follow in terms of international businesses releasing earnings and telling us what could happen in the quarters ahead. So that's how things are shaping up. Take care out there. We've released plenty of information across our research team, the broader investment team, a few things from me, a few things from some of my colleagues. Get in touch with your advisor, jump on our website. There is a raft of information out there that will hopefully help you navigate this period. So my advice will be stick close to your advisor during a period like this. There are opportunities, as well as things to worry about. So it's not all bad, but you do want to make sure that you are regularly staying in contact to keep on top of things. Oh, and last final piece of housekeeping, I will be away this coming weekend for Easter, so there will be no week ahead report, no podcast episode about the week ahead. So I'll talk to you in 2 weeks' time on the same topic. I've got a couple of other things that I'll release in between that period as well, but we won't have a week ahead session for another fortnight. So take it easy, and hopefully markets will be a little more settled by the time I get back. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.